Good morning, everybody. For those of you who don't know me, I'm Christine Bureau with Stewart Title, the Western Division. And thank you all for taking the time this next 45 minutes to an hour and joining us for some really good information. Just a few housekeeping items up front. If you all could just make sure your cameras stay off, turn those off, and keep yourself muted through the presentation. That way we don't get any background chatter or anything. And then if you do have any questions, go ahead and throw those in the chat box. I do have someone monitoring that, so we will have some time at the end and we'll get to hopefully everybody's questions and get those answered. So I'm going to just start right off with introducing our wonderful panelists today. So Jeff Kale, he had some late changes with his family and had to head over the hill to the Bay Area a day early, so he's not going to be joining us today, but we do have the wonderful Michelle Piccinini. I hope I said that right. Piccinini. With New American Funding. She was so awesome to just jump in and join the panel today. She is sitting on a panel with 17 years of experience in the mortgage and lending world. So she is a wealth of knowledge. She is the senior loan consultant with New American Funding in South Reno. So thank you, Michelle, so much for joining us today.
Thanks for having me.
Next we have Brandy Marshall and Kyle Rush with Guild Mortgage. Brandy is the senior loan officer and branch manager for Guild Mortgage in Minden. She has been in the mortgage and lending business for 18 years. So thank you, Brandy. And then Kyle is the senior loan officer and branch manager for Guild Mortgage in the Carson City office. And he is bringing 19 years of experience in the mortgage and lending world to our panel. So thank you both, Brandy and Kyle. After that, we have Mike Rayburn. He is the sales manager and mortgage advisor for Finance of America in Carson City. He has 10 years of experience in the mortgage and lending world. Most of that was spent in Reno, but he recently has joined us, down in Carson City where I am, and opened a branch down there. And so he's in Carson City now, but he's a wealth of knowledge and has 10 years experience. So thank you, Mike, for being here. And then Steve Roberts comes all the way from Salt Lake City to us. He's going to be joining us more on like a national level, going over kind of what's going on across the US. He is the Chief Business Development Officer and National Sales Director for Intercap Lending in Salt Lake City. And he brings over 26 years of experience to the panel. So, and he's done all, as I understand, facets of mortgage lending in all different ways. So thank you, Steve, for joining us. And then last but certainly not least, we have Nick Serrano, the Vice President of Sales with Greater Nevada Mortgage. He brings 16 years of experience to the panel, and he is a certified mortgage banker and accredited mortgage professional for MBA, the Mortgage Bankers Association. So thank you, Nick, again for joining us. So with that, I'm just going to go ahead. It's over 100 years of experience with all these wonderful mortgage lenders that we have sitting here. So that's a lot. We have some good information to bring to you today. So I'm going to go ahead and jump right into the questions we have. Michelle, you're up first. Thank you. So I'm just going to run through the questions and you guys go ahead and answer, give us your answers. So what are some of the challenges that you foresee in the industry going forward with COVID-19 going into 2021?
I feel like I should be having like Crazy Train or Welcome to the Jungle playing in the background right now, because I think that's where we are. Even just heading into 2020, I really think that we expected rates to start to increase, which I think would help kind of mitigate the drastic increases we are seeing in purchase prices. And then all of a sudden we find ourselves in this global pandemic, and instead rates dropped even further. And so what that did is that just spurred the inventory that we had available to start to disappear. And with the pandemic came the mass exodus from California. And I think that's really contributing to a lot of what we're seeing right now. And in moving forward, what we're dealing with. Our economy has truly been a sell to buy economy, where if you want to buy, You're going to sell your current home, you're going to move up, you're going to move down, but there's the give and take. You get a listing for a sale. And what we're all experiencing right now, especially with what we're seeing from everyone coming here from other states, is that they're not bringing anything to the table. Instead, they're just taking from the listings that we do have available. And when you can sell your shack for 2 million, you can come here and pay whatever you want. And truly, you're not being impacted because you're still in the green. So what it's doing is creating this perfect storm for our local economy, because our local buyers are now struggling to even compete in their own hometown. And we're seeing this across the board, where if you're not able to go way above appraised value, if you're not able to come in with cash, if you're not able to compete, we're having, and I'm sure everyone can attest to this, we're having really, really challenging conversations with our clients right now. And you're having to prepare them for battle, because we're down to such a limited inventory. And now, March of 2021, we're seeing rates increase at a rapid pace. And so the buying power that maybe you did have last year when you were concerned about purchasing because maybe your job wasn't secure or you were sent home and you didn't want to take the risk, now as we're opening back up and people are coming back to the table, the conversation is completely different, because now rates are higher and purchase prices are higher and we have very limited availability of properties. So it's almost created this perfect storm for our clients to where they have very limited options. And, you know, I'm thankful for the agents that we work with. I think that's a lot of it. I can't imagine what they're going through now either, because those are some difficult conversations they're having to, you know, to deal with as well. And moving forward, unless someone can start putting houses into our market at a very rapid pace, I think it's going to be more of the same. And
Okay.
I think we're going to experience a lot of what we're experiencing right now.
Okay. Yeah, it takes a little bit for, it's like a ripple effect, right?
Right.
Takes some time after a year of it to calm down. Perfect. Okay. Brandy and Kyle, whichever one's taken this one. Do you foresee the forbearances that were kind of taken out due to COVID being an issue for individuals in the future, getting a loan, and how long that's going to take to kind of flatten out?
Yeah, great question. One that I drew the straw on, so I get to deal with this
Perfect.
one. So forbearances, guys, as we know, the pandemic hit, the government came out and announced that if clients were in need of deferring their mortgages, they could. Here we are a year later, and we're starting to see the trend of how many or what percentages of our portfolios went into forbearance. And I think, Christine, may I share a screen slide real quick?
Yeah, go for it. I think you're co-host, so you should be able to share.
Perfect. Can you see?
It's coming in there. Oh, there it is. Yep.
Okay, perfect. So what we've got here is basically running through September of last year from March. So the kind of the initial onset of the pandemic through September. And what this is showing you guys is pay attention to the middle percentage. So back in March, the forbearance as a percentage of portfolio for the industry was about 2.7%. And you can see that that spiked all the way up to 8.5% in May. And then we started to kind of tail off towards September. I wasn't able to get the figures for October, November, and December, but I was able to get March of 2021. And guys, we're now down to 5.2%. So we've seen this trend move up and spike at the height of or the middle of last year, and now it's really trended down. So this shows us that a lot of these clients that have gone through that forbearance process have now modified and exited the forbearance or deferment process. So that's good news, right? And we know that in our industry, we need them out of forbearance and back into 3 months of mortgage payments before we can help them. So I think as a whole, that's a great sign. If I had to pinpoint who I think is going to be impacted the most by forbearances and COVID specifically, it's really self-employed borrowers. That's probably one of the hardest loans to work on right now, because when we look at it this way, when we're dealing with a W-2 client, someone who's on a salary or base pay, it's very easy to verify the continuity, consistency, and stability of that income at any time. We can do it at the onset of the application, on the last day of the application. When you're self-employed, it doesn't quite work out as simplistically, because that borrower only reports income one time a year when they file their taxes. And so we know that most businesses were impacted by COVID in the last 12 months. So I think that to kind of summarize, I'd say that the forbearances look like they're trending down, guys, but we also have to recognize that a certain sector of our business in our economy will probably not return anytime soon, which means that, yes, people are going to continue to be impacted by forbearances and deferments. I think the heavier impact really falls on the self-employed side of things, and the nightmare it is for us to qualify self-employed borrowers. And to kind of put that in scope, guys, what we're doing is all of us lenders are running anywhere from 3-month to 12-month to 15-month P&Ls for these borrowers. We're comparing their deposits and their withdrawals in their bank accounts compared to their pay and the average of their tax returns in their P&L. It is probably one of the most tedious and challenging things to do, because the first, probably not a big surprise to any of us, not everybody tracks their business or accounts for their business in the correct way, right? And so there's a lot of intermingling of personal aspects into that. So I think that's probably the biggest impactor, is our self-employed clients are going to have a real tough time entering back into the market. As they catch up with filing taxes, that's going to make it a lot easier. But with the trend we're seeing of forbearances lowering, the economy essentially returning to some form of normality, right? And that's what Michelle spoke to, is as these rates increase, guys, when we're in a healthy economy, we should be expecting rates close to 4%.
Perfect. Thanks, Kyle. So Mike, you get the question of the day, the question of the year. What's going on with rates throughout the year? What do we foresee with that? And then with that question, there's a couple parts to this one. What is it worth to buy down a rate if, say, you're not going to live there for more than 5 years, or when is it worth buying down a rate? And then also at the tail end of that, can you explain a little bit of difference in APR and interest rates? So go ahead.
Sure. Let me get my crystal ball out
Yep, get your crystal ball out.
here, get into my yoga stance and start chanting, and then I'll figure out the rate.
Right, like everybody.
Loaded question for sure. What are rates doing, brother? I know it's funny. Just looking at the interest rates just a year ago, they were like, if you guys remember, there was about a 3-week period around, I don't know, it started close to the end of February, went through March, and I mean, man, it was up. And I mean, daily, just quantum. And then finally, did what it did, and rates dropped significantly low. And now we're starting to see the same thing a year later as we're pulling out of it. Rates are going crazy, but they are climbing up. No question about it. And that's due to several factors. One, the big one, inflation. Investors, they're not a bottomless pit. They don't have all the money in the world like everybody thinks they do. So they've got to recoup their losses as a result of inflation, just like anybody else. So, yep, the prediction is that inflation is going to climb, as we heard from the Fed chair, Jerome Powell, just say this week that he's looking at, 2.5 here coming up in the next month or two. So rates are going to continue to climb. Prediction is they're going to then steady, kind of hold out. And then the last quarter of the year, they're thinking that they're going to slowly go back down. But will they go down to the levels that we have seen during the year of COVID? I don't think so. I think the important thing of here is, yeah, we see rates climbing up, but the sky's not falling. Everybody thinks, oh my God, rates are climbing. But when you look at what it was a year ago, rates are sitting pretty much steady to what they were before COVID, right before COVID hit. They may be 1/8 of a point higher right now. I don't know how much higher they're going to go. They're saying they're going to keep climbing, but let's still sit back and realistically look at this. Is that a year ago, rates were, 3.25 as an average, depending upon circumstances, loan program, all that. But that's where we're climbing back into right now. And so it's not like 5% and 6%, like, oh my God, I'll never be able to buy again. So, we don't want to panic and go into a negative Nelly routine and think it's the end of the world. Past is the past. We can't control it. We may not see 2.5%, 2.25% again for who knows how long. But hey, you know, they're still good rates overall, considerably speaking. Really big factor for buyers right now is the cost of housing, the pricing just climbing through the roof. It's not because of interest rates. You know, may factor in, it will undoubtedly. The ones that are first-time home buyers trying to get their foot in the door, yeah, they're going to be impacted, no question, but not as radically as the price of homes keep climbing. That's the big one. Your other thought on buying down the interest rate, you know, it's going to be dependent upon circumstances. Sometimes you can buy down an interest rate, say 1/8 of a point, 1/4 of a point, 1/2 a point even, and only cost you a few $100, maybe $1,000, and you've got the money in the bank. Hey, go for it, then do it. But if you don't plan on being in the house more than 5 years and you want to buy down a rate by a full point, and it's going to cost you $5,000, $7,000 to do that, you may want to rethink it. Because if your plan is I'm only going to be here 3, 4, 5 years and I'm selling, you might want to keep that $7,000 in your back pocket, and because it's liquid and you can get to it, and you may not recoup that cost simply because you want to lower the rate. I find a lot of people view interest rates like a badge of honor. You know, they all sit around the bar drinking the beer going, hey, what rate did you get?
Mm-hmm.
And I got mine at 2.355, you know?
Yeah.
You know, all they're doing is saving a few dollars, you know, a month, but it costs them 10 grand to do it. You know, is it worth it? You know, but if you do plan on staying in the home for quite a little while and 30 years, and you want to raise your family and stay in the community and not move around, then yeah, buying it down, then it's worth it, you know, because you'll see the money come back. But if you're short term, it's not my recommendation anyway.
Okay.
I think your third one was what, APR and interest rates? That's another good question. APR stands for annual percentage rate. And what that is it represents all of the costs associated with your loan rolled out in a 30-year period and expressed as an interest rate. And the purpose of that number, the APR, is so that you can subtract the interest rate that you're paying the investor, that is the fixed rate that's on the loan, that you're making your monthly payment out every month, that you're writing that check or automatic withdrawal, whatever it is, that interest rate that you're paying the investor, you subtract that from the number on the APR, and then that tells you as a percentage what the cost is of your loan. And the reason why that number exists is because federally they want you to shop. So you could go to another lender and see they charge you a higher interest rate, but the APR may be lower than the other lender. And the result is it's not costing you as much for that rate. It allows people to shop. So you'll go in and say, yeah, lender XYZ is giving me 2.75% and my APR is 3%. But then I go to another lender and they're offering me 2.75 and their APR is only 2.85. You know, how much are you paying to get that 2.75? It allows people to shop and compare the cost between lender A and lender B. And it's not just that, but that APR also exists on credit cards, on your car payment. It's on everything. So it allows
That's a numbers game. It's basically a numbers game.
Correct. Very much. So there you go.
Perfect. Thanks so much, Mike. Steve, you're up. With our political landscape changing in 2021, coming out of an election year, how do you think the real estate lending market will look different this year and going forward?
First of all, I think that's a loaded question.
It is.
Politics, but anyway, I will address it. It's been interesting to watch. I think that the government backed real estate lending is really taking a sharp turn towards primary residences. And I think we're seeing that towards what's happening with investment properties. It's obvious to me that it looks like they're trying to slow down the investor to make room for the owner occupied, for the primary residence. I also see a focus on minority home ownership. and affordable housing, which are two things I get passionate about. But I think that that's definitely a good thing. And the other thing I think that we're going to see more of is potential grant programs coming down the pipeline, which for everybody's been in this business a long time, obviously, and on this call. So, grants, I remember the day, I don't remember the year, but early 2000s or late 2000s on the grant program, it was crazy. I mean, couldn't write loans fast enough. So I think that is going to be a big push. The other one, obviously, that is inevitable is compliance. I think there's going to be a strong lean towards compliance. We're seeing that with a shift in some personnel changes with the CFPB. I think enforcement actions are going to come back into play, coupled with, they're already starting to recruit pretty heavily with the CFPB, from my understanding. So I think home ownership on primary residence, compliance are going to be two of the main things that we see from the political shift with the current administration.
Okay, perfect, thanks. All right, Nick, there is talk about maybe another short sale foreclosure boom happening, either with, the unemployment or overpaying for properties possibly. So what are your thoughts on another big boom in short sales and foreclosures?
Thank you very much. And I appreciate Stuart Title inviting us all on today and allowing us the chance to share some of this. Yeah, there has been talk, not as much recently, but what we need to understand relative to this topic is anytime that there's a macroeconomic impact, like a pandemic, there is going to be concern and discussion regarding loss mitigation up to and including short sale and foreclosure. And so it's inherent and only natural that as we progress through 2020, that we would have this kind of discussion in the market. There's a couple things we just want to focus on for this panel. One is to first and foremost pay attention to employment. If we go back in time to the housing crisis, there are a variety of factors going on there. The shiny bright light that people go to is exotic mortgages and so forth. But the reality was back then, unemployment and underemployment were the driving factor with people losing their homes, and it's always going to be the primary factor. Back then, what isn't talked about are the millions of people that were in 30-year, 20-year, 15-year fixed mortgages that lost their house. Their payments didn't change, but their employment status did. That was the important part. And as we have progressed through 2020 and into 2021, one very important thing has happened, and that is a lot of people have been able to get back to work, have become gainfully employed again. Those self-employed people have been able to get their shops back open, as Kyle was mentioning. This is a critical factor in mitigating the concern regarding short sale and foreclosure. And so the first and foremost, if you want to wonder if this is coming down the pike, you pay attention to employment numbers and see what's going on there. Because when people are employed, they make their payments. It's not absolute, but that is definitely what transpires. The other key part is that's different, because naturally when people start talking short sale and foreclosure, they want to compare any time frame back to the housing crisis. There's one dramatic change, and that is equity. So we got two E words in this answer: employment and equity. People nowadays have a vested interest in retaining their home, as opposed to 2008, 2009, when their home was underwater. Instead, now they want to find ways with their servicer to keep their home, make enough of a payment at the very least, or get into a loss mitigation tactic that keeps them in their house because they've obtained record-setting appreciation in their home. There is a vested interest, right, in the value of their house that was not there when we naturally compare anything like this to the housing crisis. So as it comes to the short sale and foreclosure dynamic, a natural conversation to be had. When it was first coming up in the spring and early summer, we were at the height of fear, right? And what was going to transpire in the unknown. We're much more settled today here in March 2021. As we watch those employment numbers and as we understand the vested interest of equity, and we also understand that lenders don't want homes back. We learned all as an industry a tremendous amount of lessons a decade or so ago. When you factor those all in, it is not a likely scenario coming forward. but it only takes one more major shift, to change the discussion of the panel that we're having here today. But focus on employment, recognize the equity that is in people's home, and you start to go down a path where there is not a tremendous amount of concern on this, certainly today compared to when this topic came up last summer.
Perfect. That's some good news, Nick. I like that news. Okay, so we're going to circle back around. A couple more questions to Michelle. You're up. What are some just things you're seeing and challenges you're seeing from appraisals or appraisers getting appraisals, and what's going on in that world?
Challenges with appraisals. I have a lot of empathy for appraisers right now, mainly because market value and appraised value, as we all know, are two different numbers. And what we're seeing is there are really no comps right now. The discussion with agents and with lenders about what a home is worth isn't how the conversation ends. It ends with, well, it may be worth X, but it'll take you Y to win. So when you're looking at those two different numbers, it's an appraiser's job to now justify that contract price. And unfortunately, if there are no true comps that support it, that's where we have our issues. And that's where we're running into the frustration on the agent side, on the appraiser side, on the lender side, because we all want the deal to close. We want it to work. But when you have people that are utilizing frustration and desperation and just the fear of not getting into something that is now basically dictating our market, that is now controlling what those values look like. And for an appraiser, you do have to show active comps. It is required, yet it is to dictate a market direction. It is not to dictate a value. And even if an agent was to show the appraiser, I had 21 offers. So tell me how this isn't justified. Until there are sales that support that closing, it's not a value. You can make adjustments, but those adjustments are also limited. And I think that's one of the big frustrations is that, yes, someone may be willing to pay an obscene amount, but until you have closings that justify it, that is the challenges we're facing. And for all of us, I think the timing on appraisals is also a frustration. We're all dealing with the same panels. We all have the same 10 people because unfortunately, there are also no new appraisers coming into our market. And if they are, it is at a very slow pace. And I think the reason for that is that what it takes to become an appraiser is incredibly challenging. You have to have 1,000 apprentice hours. You have to have an appraiser that will even apprentice you. And then they're taking on the liability of the decisions that you're making as well, because they have to sign off on your reports. So we are stagnant, I feel like, in the appraiser pool, so that when we're all operating at our highest capacity and we're all needing these appraisals, then for an appraiser, they kind of get to control their fee in the market as well, which is then another frustration for our consumer. Because maybe you need an appraisal back in 2 weeks. Well, now that's going to cost you $1,200. So I just feel like across the board, it's, dealing with what we have. And I think for everyone knowing, no one wants the deal to fall apart. We all want it to work. And we're doing whatever we can to help make that happen. But when you're going into writing your contract and negotiating that offer, it has to be the conversation as well as to, no, this may be what it takes, but this may not be what it's worth. And you have to be comfortable covering that difference if that's what it's going to take to win. So I think that's the big challenge right now, is making sure clients have the available investment to make until our market can catch up.
Perfect. With that real quick, is it kind of vary every transaction, or is there a general how long, week-wise, day-wise, it's taking to get appraisals back?
I mean, we're seeing right now 2 to 3 weeks. I would say more challenging homes, or if the home is way overpriced. I mean, the order goes out to an entire appraisal panel. It's whoever picks it up.
Okay.
And if they feel like it's overpriced, the last thing an appraiser wants to do is accept an order, complete that order, and then have to go back to that same order 4 and 5 times to make new adjustments, to justify their reasoning, because then that's taking away from time that they should be spending on other appraisals. So we are seeing a lot of pushback as well with the comments, home is overpriced. And you're just like, okay,
Okay,
but I need you
yeah.
to tell me that.
Yeah.
I need that in writing. So I think that's where a lot of the frustration is too. And that's where then you're getting the request for these rush fees, because we do need it back in a quicker time.
Right.
I mean, it'll go out and sit. And so then it's the, okay, we have to move forward. So I'm sure that's something we're all experiencing right now.
Perfect. Thank you, Michelle. Brandy, I guess you got this straw. Let's talk about bridge loans. Can you explain a bridge loan and then what the benefits are of a bridge loan?
Yes, of course. Hi, everybody. So pretty exciting. The bridge loan just came out to Guild this year. And basically what it is it's a short-term financing option for borrowers on their exiting property. So borrower is selling their primary residence. It's listed for sale. One of the stipulations is the home has to be listed in the MLS or in contract in order to do the bridge loan. So they're selling their primary residence to purchase their new primary residence. And it is for well-qualified borrowers. You have to have at least a 720 middle FICO score. You have to have at least 6 months reserves for your exiting property on that principal interest, tax and insurance or PIT payment. You have to have plenty of equity in that exiting home. Example for round numbers, homes worth $1 million these days, very common. They have a current loan of $450,000. They get a second on this bridge loan for $250,000. They now have a combined loan to value with their 2 loans of 70%. That is our max combined loan to value, is that 70% on the exiting property. These loans go anywhere $1,000 is our minimum, up to $250,000. It is, like I said, short term, so it's 5 months, interest only, and it is due on that 6th month. So one thing it doesn't do is you still have to do a contingency in your offers that is contingent upon the bridge loan closing with your new. But it does allow that borrower time to sell that exiting property. So it is not contingent on the sale of that home. So it gives them a little bit more time to sell the house. Let's see, make sure I covered everything. You have to have an appraisal on the exiting property. So you have to make sure the value's there. There is 1.5 point cost associated with the bridge loan. They have to qualify for the new purchase payment, the exiting property payment, and the bridge loan payment. So again, these borrowers have to be well qualified. Credit, good money in the bank, low debt to income ratios, real solid client. But it is working for some borrowers in order to get into that home, and the loan close simultaneously with your first. So this isn't going to be your cash buyer that wants to pay off all the loans right after they close. They are going to want to keep that first with their new purchase on their primary residence. So it's a great option to get in there and give the borrower some time to sell their exiting property.
Perfect. Thank you. Sounds like a lot of stipulations, but could be a really good product. Okay, Mike, another kind of loan program that has been brought up a little bit. Rehab loans, are they still a thing? What are the parameters for the rehab loans? Can you explain a little bit of that?
Sure. It's funny, they're just starting to come back. The loan programs, they're there, the 203K and the home style, through Fannie and Freddie Mac has a program as well. They exist. What had happened was when COVID hit, I can't speak for every lender. You got to remember that investors, like we said, they're not a bottomless pit. And so when interest rates dropped really, really low and the refi boom hit, some investors kind of started putting a hold on certain products so as to be able to have the funds to feed the more common products, the refinances, conventionally FHA. So some products were put on hold. or put in suspense. That happened to us with our renovation products. They put those on hold. We have a construction to permanent loan program, as well as all of our reno products. They were all on hold. Well, they have come back just a few months ago, and they're still in existence. So most people, when they refinance their home, because they were getting, they were shut in their houses, so they learned to be content. We've learned to be content with what we have. And so some of those refinances it's done, when they did a cash out, they would say, hey, we're doing some light work around the house, maybe doing a painting or new flooring or some kitchen remodel or whatever. And they use the funds, cash out on the refi to do it, and they kind of control the product themselves as a result. Now that those products are starting to come back, I'm curious as to what direction they're going to go. Because of low inventory, they may become, and they could potentially be a big item again. There's going to be, in my opinion, two different sellers. There's going to be the ones that, yeah, you know what, we refinanced the house, we're going through, but hey, we need another bedroom. We need to knock a wall out. And so they're either going to do that, or they're going to go ahead and say, you know what, I'm going to put it up for sale and start looking bigger. So the ones that want to just stay put, yeah, those renovation programs come back. They're good. They're great. They don't have really super strict FICO requirements. They're pretty much the same as any other loan program, 620 minimum FICO. We're not talking in the 700s to get these. Big thing that you got to remember is how much work is being done to the home so as what the house will appraise for. So if you're in an area that appraises at, say $400,000, $450,000, and you go in and you want to add a second floor, knock out, do some major structural work, thinking your house is going to be appraised at 700,000, you're wrong. So that's what you got to be careful of on the remodeling, is that what are you putting in, and what's going to be the as completed value of that house, and is it worth the amount of money that you're wanting to spend to get there? So that's the only cautionary tale on it. Plus, the other thing is most renovation projects, it's not owner builder. You got to have a contractor. A licensed contractor will do the work. You can't be the homeowner and saying, yeah, I'm going to strap on my belt and knock out this wall myself to save some money. It doesn't work that way, because now the lender has to manage and control the project, that it meets code, it gets done on time, the funds are there, et cetera, et cetera. So that's the big cautionary tale on renovation products that we have that we can offer. So they're back on the table, and my gut feel is that we're going to be getting into more and more of them here in the near future.
Okay, perfect. Yeah, I think you put anyone in their home for 6 months to a year and they just get stir crazy. I know myself, I've been like, if I'm staying here and I'm stuck here, I want to make it perfect. So thank you for that. That was good information. Steve, we'll go back to you. What challenges do you foresee regarding how competitive the market is becoming and the low inventory? And then what advice do you have maybe to overcome some of those challenges?
Well, I think everybody's concern is the competitiveness of the market right now. It's crazy. I mean, you're seeing people that within an hour that are trying to purchase a home competing against 42 other offers. I mean, I've heard some crazy stuff out there. I think that it's going to continue to be very competitive. What I will say to that is a lot of people, I'm hearing a lot of people and a lot of inconsistencies out there amongst all of us, which is concerning to me, because I don't think anybody really knows. And here's the reality to me. And I just told a lot of my folks this in the last couple of weeks. We're not going to control what we can't control. But what we can control is our mindset. What we can control is what's between the ears, and what we can control, how we interact with people and how we educate our borrowers and what we do moving forward. That's what we can control. So we have to reset our minds, and it's almost to the point where it's not only being professional, but you've got to be a bit of a counselor, because I'm getting a lot of people saying, well, man, I took 10 applications this week. Well, that's great. But the reality is 8 of those may not even close for 6 months, because people they're competing. They're in a dogfight right now. So what are you going to do in that 8-month period? Are you just gonna just say, hey, congratulations, you're approved, hit me up when you're ready to go? No, they're not, because they may end up going somewhere else. They may end up getting influenced by somebody else because of all the inconsistencies. So we have to do a really good job staying in tune and staying in touch with all of our partners and all of our relationships from start to finish if we want to earn or win those deals. The other thing that I always try to tell borrowers is stay in the game. You know, it's almost like you're a coach and trying to give them a pep talk. This is what is going to happen to you right now. It's not the end of the world. It's just going to be challenging. Hang in there, stay the course, and you will find your home. But what's also happening is some people, they can't find it, so they end up settling on something they don't want versus getting what they do want. And that to me is unfortunate. But it's the nature of the beast right now. But even if you look back at last year, and even now it's starting to get a little better, people are really longing for social interaction. I remember doing a lot of Zoom calls, even with some loan officers and different people, and the lights are dim and it's just dark. And I'm like, God, get that guy or gal some cookies, send over a ASAP, because we're about to have a man down, you know? We got to get back to normal, and we've got to stay positive through all of this of what's going on. And to Michael's point about the rates, man, my first loan was a VA loan at 12%, and I rubbed together. And by God, I made it. You know, I paid my bill. I figured it out. 4% interest rate. Are you kidding me? That's a good deal. And we need to be solid about that and educate people and make them feel at ease. The sky's not falling. Things are still really good. Is it competitive? Yes, it's competitive. But is it doomsday? Absolutely not. This could still go down as one of the top 5 mortgage years in the industry. And I'm watching people, you know, pack the bags. We're going on a guilt trip. Woe is me. It's okay. Everybody needs to breathe. We are going to be just fine. People are going to buy homes. People bought homes when the rate was 12%, 18%.
Yeah.
They're darn sure going to buy homes when it's 4%. Clean out the cobwebs between the ears. Be a good partner. Be in tune to what's going on. Life is going to be good.
Perfect. Thanks, Steve. That works in all facets of life, real estate, for our realtors on the call, lenders, title, all of it. Yeah, so that's really good advice. We just have to make the best of it, right? Make
For sure.
lemonade out of lemons.
That's right.
Thanks, Steve. And lastly, Nick, we got one more question for you, then we'll get to some questions. Can you give us a quick overview? I know there's been some changes to the uniform residential loan application. So give us a quick overview of what those changes are.
I certainly will. And before I get into the last scripted question of our session, I want to thank my fellow panelists. It's a joy to get together like this. Much of this kind of dynamic has been lost over the last year, and it's a pleasure to share with you, Steve, Brandy, and Michael, and Michelle. We were doing Women's Council Realtor golf tournaments as far back as 2007, 2008 together, and I think Kyle and I have a deep and long relationship, an old friend, and it's great to see you, my man. So thank you, my fellow panelists, for joining today. Erla, yeah, let's finish with a very exciting topic, which is the Erla. Now, it is relevant for all, although a mortgage form, you know, the Uniform Residential Loan Application has not had a material change in 25 years. But much in this industry has changed. And we've been talking about what's just changed since March of last year, let alone the last 25 years. And so very quickly, a couple of key parts of the change with the IRLA. One was to bring it up to speed in terms of relevancy. And relevancy on twofold. One, updating the fields, the questions, the completion portions that we have to develop to be a better reflection of what today's lending environment is, all right? And the other thing was to align with TRID. There was not supposed to be this much of a gap between the launch of the closing disclosure, the loan estimate, and the application. And if you see the application, it should look very familiar because the new application looks a lot like the TRID documents. That's intentional. This gap was not supposed to be there, but it delayed, and here we are today launching it as a new required IRLA. What this really was for the industry of where we're at today in 2021 was as much of a technology change for the industry as it was a form change, because the IRLA is the foundational input form of any loan origination software. So what the industry has been doing, once again, much like TRID, is going through a massive software change, technology change. That is what we've been up to, because pretty much every other form in our systems populate or certainly relate to the foundational document of the IRLA. And so we've been going through big technology change. On the whole, it seems to be going well. As I talk to peer groups across the country, most of the issues had to do with integrations with MI companies, automated underwriting interfaces, and working out the kinks in those regards. But the important fact for realtors to understand, especially if they're tuned in here today, is just know that we have a new form. It's a new look. We are launched it as a required document this month. We're working out the kinks. Most people have done that and are moving forward accordingly. And that, you know, what it really does is represent a heightened level of relevancy of what today's lending market and lending questions need to be, as well as bringing it in line with other key regulatory documents, the closing disclosure and the loan estimate. And so happy to take additional questions, because it's either that short or much longer when we talk about the IRLA, and that all those would be more lender specific than general real estate populace. So I'll turn it back over to you. I think we have some other questions to wrap up our session. And again, I appreciate everybody's time. And Christine, I'll throw it back to you to take a look at the chat.
Perfect. Thanks, Nick. Yes, we did do a class an hour long with Nick on that form. So, and I believe it's recorded. I'll check on that. If you have more questions on the IRLA, is that what you were calling it? The IRLA?
Yeah, that's what we'll call it.
Yep, we'll defer those to Nick, and then also we'll see if we can get that recording up for you guys. Okay, so let's see what kind of questions we have going on over here. Tiffany, thank you. I want to learn about the bridge loans. I hope we addressed that for you. What are they, and are there pros and cons? So I think we went over that with Brandy, the bridge loans. If you have any other further questions on that, Tiffany, go ahead and throw it in the chat box, but I hope we answered those. How long are appraisals taking? Are they coming in as contract, not listing price? So we kind of addressed that. Let's see. I saw another one down here. Hold on, let me get down to it. Can you explain the recent changes that the Fannie Mae is doing about investments? Investments, my thing.
Steve did a good job of introducing that topic as he was blessed with the political question on the panel. I would just add to that. Yeah, the intent is to drive owner occupancy, to slow down the ambition, if you will, of the investment world. Yeah, Fannie's talking about a 7% cap in their portfolio. That's all they're going to take. And the secondary market is already starting to adjust to also strong whispers of significant changes in pricing structure. It's called LLPA's, topic for another time, but what that relates to is our higher rates. You know, the one quickest way to control market in our business is to price at something that you don't really want. And if someone really wants it, great, take it, because we'll take it at that interest rate, and you can have it. And so, yeah, the two big things coming are a cap in the industry with our greatest resource for conventional loans, and in Fannie, and then again looking to significant pricing changes that would impact rates, make those higher, and really look to control that non-owner occupied market, at least in the foreseeable future. So that is very real, very relevant thing. And for those realtors that have investment clients who utilize conventional lending in their practice, it's a good thing to give them a heads up on, because plenty more to come, but it's that wave is rolling in.
Perfect. Thanks, Nick. I hope that cleared that up. Are single closed loans back yet? I don't know if anybody wants to take that answer. Go ahead, Kyle.
So we do have some options on OTC loans right now, but they're still really limited, kind of similar to what Michael was mentioning with rehabilitation and remodel loans. I mean, the programs that we work with right now at Guild are specific to manufactured housing. We've not opened them up to single family housing though. So we do have OTC loans, one-time closed construction loans. The benefit of that, guys, is You're not loaning on the land, you're not loaning on the construction project and then getting the permanent financing. You're doing one loan.
Perfect. Thanks, Kyle. Let's see, last one, it looks like when homes are being purchased with cash, no appraisal, does that change the homes to reflect to be worth more than they are really worth? I guess when they go to maybe sell or get appraised. Who wants to jump in on that one?
One of you producers take it.
I know, I'm gonna say.
Steve and I are back office guys. We're boring. We're political, you know.
Michael, you want to speak to that one, or
I'll
Michelle?
jump in and talk about it.
Okay.
So guys, I think that the challenge is, every sale impacts other sales, right? It's the hardest part that I've seen is the timing of these sales, right? Until that other home closes, that it doesn't matter, to just be frank. I mean, we know that these are all being overbid and we're seeing clients pay drastic amounts over purchase price, but until that actually closes, it's not a comp. And so that's probably the biggest challenge we have is the clients are being, they're made aware of what other listings and whether pending offers are out there, but those deals haven't closed. And if my appraiser goes out on the 15th and it closes on the 17th, that deal on the 17th doesn't hold any weight on our value.
Gotcha. Okay, and this kind of goes along with it. How do appraisers look at a cash purchase? I know probably some cash purchases are waiving appraisals to get a really strong offer, but there's a cash purchase and they do get an appraisal. How is that looked at? Do you guys, can you speak to that? Maybe Michael or Michelle?
I mean, it's still just like Kyle said, until it closes, it's not a comp, but once it does, it is. And then it holds that same value as any other closing would, whether it's a loan or cash. So the hope, because cash is moving so much quicker, is that those are the comps that will kind of help spur the market and get those values higher for all of the, the clients that are doing loans. You want those cash deals to close because we know that, even cash offers right now are still having to offer well above asking price, even to be competitive. So as soon as that cash closes, then that's a comp too.
Okay. And then it looks like Loretta said, because she had that first question, she kind of meant after they close. So after the fact. So.
It's fun to see another old friend name come up. So I can't see Loretta, but hello, and I think I was reading through that as you were answering, and I don't know if this answers the question or not, but if you have someone who pays cash for a home, we're going to use easy numbers, $1 million, right? And then, after they close, how does that impact it? Is that really worth? Well, now that home is subject to the comps on the block, if you will. All right. So if they paid $1 million for it, but then they want to turn around and maybe do some kind of financing or take cash out of that house now that they're in there, what it might be, they paid $1 million for it. That's great. But now they're going to be subject to the comparisons when they look to do something different with that house, including right away. Because an appraiser is not going to go, oh, well, every house on the block's worth $800,000. I know you paid $1 million for it, so your home's worth $1 million. No, once they pay that cash deal, yeah, that establishes that home sales price and so forth. But if the rest of the neighborhood or the rest of the block are comps at $800,000, then that home's going to be subject to those after they purchase the house. I hope that answers the question. Just trying to read into that as best I could in the chat box, Loretta. I don't know if anyone has anything else to add.
That would be crazy thing.
Post-close. Yeah.
The crazy thing of what's going on right now, I just laugh. It's not funny, but it's kind of funny because I look back years ago, I had a 66 fastback that I helped build with my son. And there was always two questions that somebody would ask me when I'd come pulling up to a baseball game or what. The first one is, what year is that car? That's a really cool car. And then you tell them. The next one is, what's that worth? I'm like, I don't know. And then after about a year of hearing that, it dawned on me, well, I guess it's worth what anybody's willing to pay for it. And I don't know why, but the last year, that's kind of what I think the housing market is. It's like, well, what's that house worth? I don't know. I guess whatever somebody's willing to pay for it, because it's all over the place. It just crazy.
Yep, that's very true. It kind of plays into everything. Let's see. Sylvia Smith, our president, just wanted to say hi, everyone. I want to take a minute to thank the panelists today. Great information and great presenters. Thank you all for your continued support. So, of course, Sylvia, yes. With that, thank you guys so much. I don't think that there are any other questions coming in. If there are, I will, we can either, everyone on this call, you can either go directly to one of these lenders and answer the question that way, or send them to me and I can get them out to the panelists and we'll get you an answer too. But with that, thank you guys. Thank you everybody for joining the call. Thank you to the panelists. Great information, just wealth of knowledge that all of you have. So with that, thank you. And everybody have a good weekend. We're almost to Friday.
Thank you.
All right. Thanks everyone.